You already know what's happening with AI spending because everyone has told you. It's the dot-com bubble again. Enormous valuations, a technology everyone insists changes everything, capital pouring in faster than anyone can deploy it, and the same confident voices explaining why the normal rules don't apply this time. We've seen this film. We know how it ends. It's a satisfying story, and it has the pleasant quality of letting you feel clever without doing any work. It's also, on the specifics, mostly wrong. And the ways it's wrong turn out to be considerably more unsettling than the comparison they replace. Start with the claim that gets repeated most, that this time the spenders are actually profitable. That one holds up completely. In 1999, the money was flowing into companies that had never earned anything and in many cases never would. Businesses whose entire asset was a domain name, a logo, and a plan to worry about revenue later. Today, the overwhelming majority of AI capital spending comes from a handful of the most profitable enterprises in commercial history, funding it substantially out of money they actually earned. That is a genuinely different starting position, and anyone drawing a straight line from 1999 has to deal with it honestly. The valuation picture points the same way. At the peak of the dot-com mania, multiples on the leading technology names reached levels that required flawless execution forever just to justify the price you were paying. Today's large technology companies trade at multiples that are undeniably high, but not at those levels. Measured the standard way, this is an expensive market rather than a delusional one. So on the two most common tests, the skeptics are wrong. Here's where it stops being reassuring. Profitable companies can absolutely spend themselves into difficulty, and the numbers have started to move in a way that should get more attention than it does. Alphabet's free cash flow, the money left over after running the business and paying for its capital investment, recently went negative. Its share buyback program was halted. That combination is the tell, and it's worth understanding why. A company buying back its own shares is making a public statement that it has more cash than it has good uses for. A company that stops is saying the opposite, in the loudest way available to it. So, the reassurance that the spenders are profitable quietly assumes the profits are large enough to absorb the spending. For at least some of them, at current run rates, they no longer are. And the gap between what they earn and what they're spending is increasingly being filled with borrowed money, which changes the question from can they afford it to who's lending and against what. But the argument that really matters is about what gets left behind, and this is where the bubble comparison breaks in the direction nobody wants to look. The standard consolation about infrastructure manias is that the infrastructure outlives the mania. Britain's railway booms ruined waves of investors and left behind railways, which the country used for the next 100 years. The fibre optic build-out of the late 90s ran so far ahead of actual demand that the companies laying the cable went bankrupt, and the cable stayed in the ground, unlit, until the internet finally grew into it a decade later. In both cases, the capital was destroyed and the asset survived. Investors lost their shirts, everybody else inherited a functioning network. That's the pattern people are leaning on when they say a bust wouldn't be so bad. Now ask what this capital expenditure is actually buying. Overwhelmingly, chips. And chips are not rail, and they are not fibre. A high-end processor has a useful economic life measured in a handful of years. The working assumption inside these companies' own accounts is around 5, and there's a live argument that under continuous heavy load, the real number is shorter. That's a fundamentally different category of object. Track laid in 1870 was still carrying freight in 1950. A processor bought today is close to commercially worthless well before a decade is out, and not only because something faster exists, because something more energy efficient exists, and at data center scale, the electricity bill alone can make running the old hardware irrational. So the comforting pattern doesn't apply. If this build-out turns out to be well ahead of demand, there is no dark fibre sitting patiently in the ground waiting for the world to catch up. There's a depreciation schedule and a disposal problem. The capital doesn't lie dormant. It evaporates. There's a real nuance here, and it deserves saying because the gloomy version oversells too. Not all of the money is silicon. Data center shells, land, power connections, substations, transmission, cooling and water infrastructure behave much more like traditional infrastructure, with useful lives measured in decades. That portion will outlast whatever is racked inside it, and grid upgrades in particular are the kind of thing a country benefits from no matter which company paid for them. So there is a durable residue. It's simply a fraction of the total, and the largest fraction is the one with the shortest life. There's also a constraint on this build-out that the dot-com era never faced, and it's the least glamorous thing in the entire story: electricity. A data center needs a grid connection, and in the places these get built, the queue for one now runs into years. Transformers and high-voltage equipment have order backlogs measured the same way. You cannot buy your way past a substation that hasn't been built, and no amount of capital shortens a transmission approval. That matters for the bubble question in a way that cuts both directions. It's a brake. It physically limits how fast the money can turn into capacity, which slows any overbuild. But it also means the spending has to be committed years ahead of the demand it's serving, on forecasts made today about how much people will be using these systems in 2030, and a forecast made under competitive pressure, where being wrong in one direction means falling behind a rival, is not a forecast anyone gets to make cautiously, which raises the question of what a bust would even look like here, because it wouldn't be dramatic. It'd be a utilization number. Racks sitting idle or running at a fraction of capacity, generating depreciation but not much revenue. That's not a crash, it's a slow bleed. And it shows up in the accounts long before it shows up in the headlines if anyone happens to be reading that line. There's a second wrinkle that has no 1999 equivalent, which is how circular some of the financing has become. Chip suppliers taking stakes in the companies buying their chips, cloud providers investing in model developers who then spend the investment on that provider's cloud. None of these arrangements is improper, and each has a defensible business rationale. But they do mean some revenue is, in effect, recycled, and revenue that travels in a circle is far harder to read as evidence of genuine external demand. Then there's the question of who actually eats the loss if this goes wrong, which almost nobody raises. Dot-com losses landed mostly on equity holders, people who had knowingly bought shares in speculative companies and understood, at least in principle, that they might get nothing back. The more this build-out is financed with debt, the further the exposure migrates into bonds, credit funds, and the quieter corners of the financial system, which is to say, into pension funds, insurance portfolios, and savings products held by people who never formed a view on artificial intelligence in their lives. So, the honest scorecard is uncomfortably mixed. On whether the buyers can afford it, this is meaningfully safer than 1999. On whether the spending is beginning to strain even those buyers, it looks worse than the headlines suggest and is deteriorating. And on what society keeps if the demand doesn't show up on schedule, it is plainly worse than the railways, worse than the fibre, and worse than nearly every mania it's compared to, because this time the asset has an expiry date. This bubble is different, is true. It's just not the reassurance it's being used as. It's different because the spenders are real businesses with real earnings, and different because what they're buying wears out before anyone can inherit it. Both things are true at once, and most people are only ever handed the first half, which leaves the question worth carrying. When the case for staying calm rests on the buyers being able to afford it, is anyone checking whether they still can, or only that they used to be able to?